Hi everyone, we are group 1 with the Columbia Memorial Hospital case study. We have Kristen, Abrick, Brooke, Alicia, and Lauren in this group. Our summary for this case is basically Memorial Hospital is not making the money that they need to. They're trying to decide whether or not they should remain open. They have 3 options. They can leave everything as is and make no changes while also losing money, close the clinic altogether, or implement a new marketing campaign that would try to increase their revenue. So you'll see in the following slides what we came up with about changes that Columbia Memorial can make.
For the profit and loss statement, you'll see here that the clinic is currently losing $3,173 per month. And if you're looking at figure 6.1 in the case, it shows your fixed costs. And the only variable costs that we were able to find were the $3.50 per visit on figure 6.2. And then to find our fixed costs, we took the total cost and subtracted the variable cost to give us our fixed costs for this profit and loss statement. Abrick?
Abrick, you're up on slide 3.
I'm sorry, I had my volume muted. To demonstrate the break-even point with the new marketing plan, we made a graph. The x-axis represents the money, and the x represents visits in a given month. The red line represents cost, which shows a fixed cost of $7,000 for marketing. The semi-fixed cost based on the additional visit per day and $3.50 per visit. The green line represents sales, which shows the average amount that they were making per visit, which was $40.66. The cost and sales lines intersect at 592 visits, which means that they will need 20 additional visits per day to break even with their revenue and expenses.
In this slide, it tells us that we're supposed to now think of our clinic as a for-profit corporation and that we have to pay taxes. And the question is, what impact does our tax status have on our break-even analysis? If we had taxes, they would most likely be fixed costs, and adding the taxes would raise our total fixed costs, which would cause our break-even point to be higher than our initial calculations. And how much higher would depend on what tax bracket we were in and how many taxes we had to pay. Our break-even point, without considering the new marketing program, would be an additional 2.6 visits per day. That would cause us to break even without the new marketing program. And the chart on the side here shows us our total costs is the orange and our revenue as the blue, and where they cross is our break even.
In this question, we think about the value. So the question states, does the clinic have any value to the hospital beyond that considered by the numerical analysis that we just conducted? Without looking at the actual analysis, the clinic does have value to the hospital. If you think about the clinic, it takes all the non-life-threatening illnesses and injuries, and if it was closed, the hospital would take all of those patients, which creates less room for the critical ones. The second question is, do the actions by the Baptist Hospital have any bearing on the final decision regarding the clinic? While the Baptist Hospital is a major competitor, we consider it it doesn't bear on our final decisions with the clinic. The clinic should proceed with whether it closes or opens. And if it does stay open, then it needs to keep in mind the financials in the future, especially with the group practices open. We want to make sure that the number of patients are increasing, not decreasing, because of those practices.
So now we have to take in consideration malpractice insurance. This one is not going to require any calculation, but it does require some critical thinking. The first question, or the first part, is says, suppose that you just find out that the $3,215 monthly malpractice insurance charge is based on a counting allocation scheme that divides the hospital's total annual malpractice insurance cost by the total annual number of inpatient days and outpatient visits to obtain a per episode charge. So we have to think about those. Now, it follows and saying, then the per episode value is multiplied by each department projected number of patient days or outpatient visits to obtain each department's malpractice cost allocation. So our question here really is, does this allocation scheme bias your break-even analysis? We thought that, yes, it does take in consideration our break-even analysis, because the cost allocation scheme, it has to be divided among all departments, which cost less, which means that it costs less, it would need to allocate to the clinics because it's formed around the cost allocation of each and every single department. So that means that our break-even analysis could result in less visits per day. It all depends on our cost allocation for the clinic. So in all, basically, I thought that there would be no reason to pay malpractice insurance if we're not using it. The amount of outpatient visit determines the amount of department pays in malpractice insurance. So why would we need to pay if we're not using it?
Our final conclusion for the outcome of Columbia Memorial Hospital's walk-in clinic is based on whether or not we see an increase from the marketing proposal shown in the previous slides. If there's an increase in volume and revenue, then our recommendation would be to keep it open and continue working in that way. However, we don't have that detail, so our current recommendation is to close the walk-in clinic, just because it's more likely to continue seeing a decrease monthly and be in negative based on our revenues. We're excited to see what you all have to say about our calculations and compare what everyone else has gotten. If you have any questions, we'll address them in the discussion board. Thanks.
Thank you, everybody.